Do you see any change in interest rate and monetary policies around the world?
Well, at Aberdeen we think it's pretty clear. The developed markets need to have very low interest rates for a very, very long period of time. We can see no reason for the US or the UK or even the ECB to want to raise interest rates at any time in the near future. So our view is that rates will be pretty much unchanged for quite some time.
Are you more focused on duration plays or on credit bets?
What we like to do is have a fairly diversified approach. So we'll have, we might take a duration call, we might take a yield curve call. We'll certainly take calls in credit, and we'll take a decision on emerging markets, and we like to have a nice diversified set of opportunities. Right now we're pretty much duration neutral in our developed markets. We're a little bit underweight duration in the emerging markets, but we've got higher yielding portfolios because we've got longer maturities. We still think there's plenty of scope for yield curve flattening. So in terms of direction, flatter yield curves, duration pretty much neutral. In general, we like investment grade credit markets. In our more diversified portfolios, we've got a pretty good allocation to emerging. We like emerging markets. We think there's plenty to offer there. We're a little bit more cautious on high yield, but in general, neutral duration, yield curve flattening, some overweight credit, and off-index exposure to emerging markets.
Why specifically you're still interested in emerging market debts?
The debt dynamics for the emerging economies are so much better. And I'll just give you an example. Italy, okay, you have a balanced budget here in Italy, but you've got 130% of debt to GDP in 2013. The IMF have just said your growth rate for this year is going to be minus 1.5. Compare that to Mexico, a country which we like, a country which we're long of when we've got a good exposure to their currency and their bond market. 43% debt to GDP, 4% GDP growth this year. Okay, a little bit of a budget deficit, and their yields are higher than Italy. So, debt dynamics on one hand, that was a big driver. The other thing really is that over the last 10 to 15 years, the emerging markets have becoming an asset class in their own right. They're attracting long-term investors like ourselves. The credit quality is definitely in an uptrend. So it's not the market it was. And there's a big problem with the perception of risk between the risk you take when you invest in emerging and the risk that you take when you invest in developed. And those risks are converging because of the amount of debt that the developed markets have, and because the emerging markets are pretty much free of debt.
Do you see a deflation scenario?
We think that actually there's going to be there's going to be food and energy inflation, but in services and in manufactured products there's probably going to be a continuation of deflation or no inflation. Can we see deflation coming in and dominating the situation? It's a risk, which is why the US Federal Reserve and why the Bank of England and why the Japanese Bank of Japan now is pushing so much money into the market, is to stave off the risk of deflation. And we think they've done a pretty good job so far, so we've no reason to suspect that they won't be able to continue to do that job going forward from here.